You see these massive companies like SpaceX or OpenAI, and you can't help but think, man, if only I could have gotten in before they went public. That whole dream of being on the ground floor, it used to be just for the super rich, right? Well, now it feels like that door is creaking open for everyone. But what if that open door is actually a trap? Let's get into it and really decode what's going on in this secondary market.
Okay, take Airbnb. When it went public, the big institutional investors got to buy shares at $68. But by the end of the very first day of trading, the price shot up to over $146. That's a 114% pop. For you and me, the regular folks buying on the open market, the biggest, fastest gains, well, they were already in the rearview mirror.
And that right there leads to the big, frustrating question for so many of us, doesn't it? You see those crazy headlines, that massive first-day jump, and you just have to wonder, is the real money already off the table by the time I can even click the buy button?
So here's what we're going to do in this explainer. We're going to break it all down. First, we'll tackle the IPO pop problem. Then we'll dive into how investors are now chasing these unicorns. After that, we'll expose a really dangerous trap, confusing price with value. We'll also navigate the liquidity trap, something most people overlook. And finally, we'll learn how to apply some second-level thinking to this whole new game.
All right, first up, the IPO pop problem. This is really the core feeling that makes people want to get in earlier. It's this nagging sense that by the time a hot company is available to you, all the smart money has already made a killing and moved on.
Let's just quickly break down how this works. An IPO, or initial public offering, is where investment banks set an initial price for a company's shares. Now, that price is offered to their big clients, the early investors, the insiders. But for the rest of us, we can only start buying once the stock actually starts trading on the open market. And that's often after that huge price surge has already happened. You're basically buying into the hype, not that ground floor price.
And all of that frustration has really fueled the rise of a whole new way to invest, one that promises you a ticket to the show before the IPO. So let's take a look at how people are chasing these private market unicorns now. Okay, so one way is angel investing. This is the classic, super early stage stuff. We're talking about finding a company that's maybe just a couple of years old. Sometimes it's barely more than an idea on a napkin. You give them the seed money they need to get started. Now, it is incredibly risky. Most of these startups will fail. But if you pick a winner, the returns can be absolutely mind-blowing.
Now for the bigger, more mature private companies, even the path to going public has changed. The traditional IPO is this long, painful process full of paperwork. But then, after the huge, spectacular failure of WeWork's IPO, this other thing called a SPAC, or a blank check company, just exploded in popularity. It's a much faster, less scrutinized way for these private giants to hit the public market.
And this is what everyone's chasing. It's like we have a magnificent seven in the private markets now. You've got companies like OpenAI, Anthropic, Databricks, all with valuations over $100 billion, and they're still private. The amount of wealth being created before these companies even think about an IPO is just staggering, and that fear of missing out is very, very real.
So how do you get a piece of this action? Well, the answer is the secondary market. All these new platforms have popped up, and they basically act as matchmakers. They connect early employees or investors who want to cash out some of their stock with regular retail investors who are dying to get in. So you're not buying new shares from the company itself, you're buying existing or secondary shares from somebody else. And this sounds like the perfect solution, doesn't it? But, and this is a huge but, it is not that simple. See, the private market isn't just an early version of the stock market, it's a totally different game, with its own rules and, frankly, some enormous hidden traps. And the biggest one? Confusing the price of something with its actual value. The key idea to get your head around here is intrinsic value. This has nothing to do with the stock price or the hype. It's about the real fundamental health of the business. For private companies, there's actually a formal process for this called a 409A valuation, which figures out the fair market value. That's the number that really matters. And believe me, it can be wildly different from the price you're seeing on some secondary market platform.
And this quote just hits the nail on the head. Price is what you pay, value is what you get. In this mad dash to get into the next big thing, a lot of people just stop thinking about the value. They only look at the price and assume, hey, if the price is high, the value must be high too. And that is a really dangerous and often very expensive mistake.
I mean, if you want to see how disconnected price and value can be, just look at a huge, stable public company like Amazon. Its stock price can swing by more than 50% in a single year.
Did the actual fundamental value of Amazon's business really change that much in a few months? No, of course not. That's just market sentiment. Now imagine that same volatility, but in a market with way less information. The gap between what you pay and what it's worth can be a canyon.
So take that madness, but now imagine there are no breaks. In private markets, there's no public PE ratio to give you a reality check. There are no quarterly earnings reports for everyone to see. The valuation is often just whatever price a big VC paid in the last funding round, which could be driven completely by hype. You could be paying a 50 or even 100% hype premium over the company's real 409A valuation based on nothing more than one investor's really optimistic bet.
Okay, so let's say you somehow navigate that valuation minefield. You're not out of the woods yet. Now you face the second great danger of the private markets, the liquidity trap. And it's so important to understand this. Getting your money in is the easy part.
Right? We totally take this for granted with the stock market. You click a button, you sell your shares, and in a couple of days, the cash is in your account. You have total freedom, total control.
This quote right here, it perfectly captures the terrifying reality of investing in private companies. Once your money is in, it is locked up. There is no sell button. If your life changes, if you lose faith in the company, if you just plain need the cash, there is often absolutely nothing you can do. And here's the brutal truth of it. Your money could be tied up for 5, even 10 years. But here's the really scary part. Even if the company gets acquired, you could still get absolutely nothing. This is because of something called liquidation preferences. It means the venture capitalists get their money back first. So if a billion-dollar company sells for, say, $500 million, the VCs might get all of it, and your common shares, the kind you buy in the secondary market, could literally be worthless. You are at the very bottom of the payout pyramid.
And this brings us to the final, and maybe the most critical piece of this puzzle, the information gap. To have any chance of succeeding here, you have to realize you're playing a game where the other players know way more than you do. You are starting out at a massive disadvantage.
You see, successful investing requires what people call second-level thinking. First-level thinking is simple. Hey, this is a great company, I'm going to buy it. But second-level thinking goes deeper. It says, okay, yes, it's a great company, but everybody knows it's a great company, which is why the price is through the roof. So, is all this hype already baked into the price, or is there some angle that everyone else is missing?
And this is the ultimate second-level question for this market. You're not buying from some faceless stock exchange. You are buying directly from an insider, an employee, a founder, a venture capitalist. You have to stop and ask yourself the most important question. Why are they selling? They see the internal data. They know what morale is like. They know if growth is slowing down. So why are they selling their shares to you? What do they know that you don't?
So how can you apply this to your own investing? Well, there's a powerful framework called Dondo, and it's all about managing risk. Instead of chasing high-risk hype in these murky markets, it says you should focus on businesses you can actually understand and look for situations where the risk of losing money is low. The whole goal is really simple. Heads, I win. Tails, I don't lose much. And that is the polar opposite of overpaying for shares in a locked-up market where you get paid out last.
And that really leaves us with this final thought. Look, the appeal of getting in on the next SpaceX, it's powerful. I get it. But this obsession with getting in early can completely blind us to the incredible risks we're taking on. Maybe the goal shouldn't be about getting in first. Maybe it should be about investing with the best possible information, the clearest picture of value, and the most control over your own money. The real question isn't, how can I get in early? It's, how can I invest wisely?